Bloomberg Audio Studios. Podcasts, radio, news.
Welcome to the Daybreak Asia podcast. I'm Doug Krisner. So the Fed's Economic Policy Symposium in Jackson Hole, Wyoming will be taking center stage this week, especially the keynote speech from Fed Chair Jerome Powell. That will happen Friday morning. I think it's fair to say that markets seem confident that a weakening job market has opened the door for a more dovish tone from Powell. In a moment, we'll preview his address with Skyler Weinand. He is the CIO at Regan Capital. Now, for markets in Asia, a key question is how the Japanese yen may react to what we hear this week from Jackson Hole. To help us understand where we may go in the week ahead, Paul Dobson joins us. Paul is executive editor for Asia Markets. Paul joins us from our studios in Singapore. Paul, thank you so much. So right now, I'm looking at a little bit of weakness in the yen, but there's no mistaking the fact that the Japanese equity market is at record highs. What is the bet right now, Paul, that the market is making on the direction of the yen this week?
Yeah, hi there, Doug. As you said, there'll be a lot of attention on the Jackson Hole right at the end of the week, but the market will be getting ready for that. And the assumption is that Powell will open the door for the Fed to begin cutting interest rates again in September. The market is pricing a couple of cuts from the Fed by the end of the year, maybe a little bit more as well. Meanwhile, the Bank of Japan is supposed to be moving in the opposite direction. It's supposed to be getting ready to raise interest rates again. That's what the market's expecting, and it's sort of been bringing forwards those estimations just a little bit. Some of the political uncertainty that's been dogging Japan seems to be clearing, and that opens the door for the BOJ to get another hike in while they can. So with the two central banks moving in opposite directions, the difference in interest rates between the two nations should be narrowing, and that should be supportive for the yen, all things considered. So market will be looking for any indications on either side that this is becoming a more likely scenario, and we'll be very much trading the yen off the back of that.
So we know that inflation in Japan is above target, and last week we had that very, very strong GDP report. Is it the market's view right now that the BOJ may hike as soon as October?
I think that that's definitely a possibility that the market's looking at. As you said, the GDP numbers were really, kind of a lot better than the market had anticipated, and that did give the stocks a real rocket boost as well. And it definitely raised those expectations for what the BOJ will do. And the BOJ, is very, very cautious still. It doesn't want to move so fast that it slows down the economy. It doesn't want to sort of crush inflation, but inflation has been running pretty high in Japan for quite a sustained period of time now, and that's pretty unpopular with the population as a whole. So about time maybe for the central bank to feel confident in being able to raise interest rates again. I think what's really interesting about that GDP figure is it gives the Prime Minister Ishida a little bit more breathing room. He can say, hey, things aren't as bad as everybody's been saying in the economy. So maybe that gives him a little bit more confidence to stay in position, and that political certainty can give the central bank in turn a little bit more certainty and confidence in moving ahead too.
Let's change gears, because at the end of last week, as you know, we had that weak data coming out of China. Industrial production, retail sales, both numbers below forecast, and more evidence that home prices in China are continuing to decline. What is the government going to do in a situation like this?
The government has been, cautiously adding to stimulus for quite a while now, making reforms, adding some extra social benefits, those kinds of things. And we had a report last week as well that it's looking for extra ways to try to mop up some of the unsold inventory in the property market as well, to try to stabilize prices there. It's also pushing ahead with these anti-involution measures, trying to prevent the cutthroat competition among Chinese companies from getting too damaging for each other and for the economy as well, to try to bring forward some further benefits and to continue to stimulate the consumer as well. I feel like although those data overall were bad and were worse than what the analysts had been forecasting, nonetheless, it comes off that very strong first half of the year where there was a lot of front loading in terms of exports. China is still running towards meeting its growth target of around about 5% for the full year. So the government won't feel obliged to go extremely hard with any stimulus. Nonetheless, the market is starting to expect that at some point, along with continued support in terms of those social measures, we may get the PBOC acting again at some point just to keep the economy ticking over, maybe with a cut in the RRR rate, or continuing to keep injections into the money markets and keep liquidity loose.
So let's talk a little bit about the trade war with the U.S. and the extent to which exports continue to hold up reasonably well. We know that there is a trade truce that is in effect now. To what extent is China really working aggressively to diversify itself away from such dependency on the American market and look at other jurisdictions, maybe in APAC or other parts of the world, so that the economy on the export side is not so reliant on the U.S.?
Yeah, that's definitely going on in the background. I think China's ideal scenario is finding some sort of a truce with Trump where it can keep those tariffs to a reasonable rate and therefore continue to export to the US. But for several years already, China has been looking at opening up new markets and strengthening relationships. We've seen quite a lot of movement with India at the moment. Of course, India also under Trump scrutiny and suddenly sort of having a think about pivoting to. So there is that. I mean, my view overall, though, of China's markets is not negative or bearish at the moment. Quite the opposite. The stock market seems to have been surviving and weathering the storm from the negative data that we saw at the end of last week, from all of this pressure on the trade side as well. And, you know, we have the Shanghai Composite at the highest level since 2021. It wouldn't take very much further for it to go to something like a 10-year high, just coming down from when the last big bubble burst. So there is pretty decent momentum on the mainland gauges and a little bit more interest in buying equities in China at the moment. There's a couple of good growth stories, right? There's the AI, DeepSeek, revolution, but also the Chinese biotech companies have really been on a strong tear this year, and the electric vehicles as well. So lots of technological kind of support there for the market overall. So
is China getting what it needs from the Trump administration to support that continued advancement within AI? I mean, certainly when it comes to advanced semiconductors, maybe not the most sophisticated, but that H20, I think, from NVIDIA is necessary, particularly in terms of training various models in AI, right?
It seems like it, but at the same time, China doesn't want to become the US doesn't want China to become used to using US manufactured chips. China doesn't really want to become dependent on those either. It would prefer to see the homegrown models coming through. And you know, so there's a little bit of a delicate balance there. We've been reporting that there's been some discouraging from going too far with H2O chip technology. Nonetheless, having access to those is definitely a benefit to the Chinese companies as they try to develop more sophisticated models as well. It feels like China is doing fine on that front, and probably, you know, relative to the US, if you look at the energy supply sector and how that matters for the data centers, for the AI industry overall, China is certainly, you know, in a more favorable position, having easier planning rules, having added a lot of renewable energy capacity recently, and being able to sort of feed and power those big data centers. Whereas in the US, we feel that maybe the electricity supply market is getting a little bit tighter as the demand ramps up for those data centers.
So we mentioned Jackson Hole, Wyoming, and the Fed Symposium a moment ago, and I'm wondering about the key things that you're going to be looking for in the week ahead, particularly within Asia.
The key things to look for in the week ahead from Asia. So first of all, at the end of last week, we had a bunch of different budget announcements from all around the region, some projections of debt issuance for next year, some spending plans as well in Thailand, in Singapore, and then in Indonesia and in India in particular. And India was pretty interesting. The Modi administration announced tax cuts and quite a lot of fiscal stimulus as well. So we'll be looking to see how that impacts the equity market, whether it can turn turn it around from a little bit of pressure that it's been under recently. I think overall, the market just continues to scale new heights in all sorts of different markets and jurisdictions at the moment, and we'll be looking to see how long that positive vibe in the stock space can continue. It will, to a certain extent, even for us, matter what the Fed and what Powell says at Jackson Hole. That, of course, comes right at the end of the week for Asia and the start of next week, but we'll be reacting to that in due course as well.
All right, Paul, we'll leave it there. It's always a pleasure. Thank you so much. Paul Dobson, Executive Editor for Asia Markets, joining from Singapore here on the Daybreak Asia podcast. Welcome back to the Daybreak Asia podcast. I'm Doug Krisner. Markets are bracing for the Fed's Economic Policy Symposium this week. It'll take place in Jackson Hole, Wyoming, and on Friday, we'll have the keynote address from Fed Chair Jerome Powell. This at a time when there is certainly a fair amount of political pressure on the Fed to cut interest rates. Markets right now seem confident that a weakening job market has opened the door for a more dovish tone from the chairman. Joining us now for a look at what we may hear is Skyler Weinand. He is the CIO at Regan Capital. Skyler, thank you so much for making time to chat with me. What do you think we're going to hear from Powell this week?
They're delving into employment, and that's what they're meeting about. I expect the speech to revolve around employment specifically, and what we're seeing, which is a little bit of deterioration in employment numbers, and specifically for newer entrants to the job market. Did you know that over 11% of males from 20 to 24 are currently unemployed that have college degrees? And so they're getting really worried about that. But also, inflation is ticking up as well. So they have this dual mandate, but they're going to show their cards this week, I think, that employment is a much bigger concern for them than runaway inflation.
So inflation is picking up. We learned last week that's particularly the case at the wholesale level. Seems to be tariff related. But let's go back to the labor market and try to get a sense of what's happening under the surface. And I'm wondering whether or not tariff policy is a part of that story, and maybe to a lesser extent, artificial intelligence. Are those forces very much at work right now?
They're huge, and we're just starting to see the start of that. And so if you take STEM education, engineers, computer scientists, programmers, a lot of those jobs are going to be done away by AI. Okay. And then when you take immigration policy, that's where the big holes are, which is manual labor. And so for the first time in recorded history, college graduates have a harder time of finding a job right now than high school graduates. And that's indicative of what we're seeing. And we're only starting to see the start of it, which is a huge gap, a huge need for skilled and unskilled manual labor. Whereas the jobs that STEM graduates were employed in, those aren't going to be necessary in mass over the next 10 years.
So I'm wondering whether or not lower interest rates can help address the issue, or whether or not we have to rethink the labor market in such a way to perhaps put less emphasis on easier monetary policy as a remedy when things start to weaken.
Yeah, I mean, and they'll say this, and Jerome Powell say this, interest rates are a blunt tool. They are a hammer, when what we really need right now is a Swiss Army knife to fix these issues. So, it's a blunt tool, but you have the administration right now that is absolutely coming down on the Fed, and specifically the Fed chair. And you have this little wrinkle, which is, 3 or 4 of the current Fed governors and folks that are sitting on the Fed want to be Fed chair. And so, they're starting to let that creep into their speak and how they're going to vote. And you're seeing them speak, and you're seeing them potentially voting, potentially against their will and against the economic will of what they should be doing, which is potentially raising interest rates.
Where are you right now in understanding the degree of leverage in markets? I mean, the S&P right now is not that far below a record high. I think we had a record midweek last week. Are you seeing evidence that there is a great deal of leverage in the system right now?
When it comes to leverage and whether we're hitting potentially, peak stock market valuations, yes, that's true. We're staring down, depending on what measure you want to look at, between 22 and 24 PE on the S&P. And so, it's starting to get folks a little bit nervous, but also earnings are catching up to that. And that's what's bringing that PE ratio down. So, yeah, you do get a little bit nervous about these daily options, 0-day delay options, buy the dip, meme stocks, et cetera. The market is getting a little heady here, but I don't think that's necessarily cause for concern given the amount of dry powder that's on the sidelines.
So we had that retail sales report last week. The control group number, which obviously is used to calculate GDP, was much stronger than forecast. Is that evidence that the American consumer, in spite of everything that we're talking about with higher rates, is that evidence that the American consumer is holding up pretty well?
In aggregate, yes. The American consumer is doing great. Tons of home equity, tons of built up cash in the stock market. You have this gigantic wealth effect. From April 1st, Liberation Day until today, we troughed at a stock market valuation of about 52 trillion. And today we stand at around 67 trillion. So you have $15 trillion in wealth that's been added over the last roughly 4 months. That's going to put a wind in the sails of the American consumer until it doesn't, right? And so whether that wealth effect's coming from the stock market or U.S. real estate and or folks doubling down on stocks returning another 10% over the next 4 or 5 months here, who knows? But I see little cause for concern really when it comes to the health of the consumer. Now, America's very bifurcated, right? And so, and that's who inflation and tariffs are really going to affect. Tariffs and inflation are a regressive tax. They are going to hurt Main Street the most. And so that's a cause for concern, obviously. But in aggregate, the consumer is doing great.
Well, at the same time, we learned at the end of last week from the University of Michigan that consumer expectations for inflation picked up a bit. And I think to go back to where we started the conversation with the Fed, that's got to be pretty concerning.
Yeah, no doubt. And I saw, a study done this past week where, the way that they're measuring inflation has changed dramatically since the 80s. If we were to measure inflation like we did in the 80s, inflation would have peaked at roughly 20% a couple years ago. And the way that they changed it primarily was using owner equivalence rent versus true housing costs. Okay. So by using owner's equivalence rent versus what people actually pay every month, OER is just an estimate. Inflation is much, much worse than what the numbers are telling us. And that's what it's being reflected in those consumer surveys.
Skyler, speaking of the consumer, before I let you go, I got to get your take on Walmart and Target. They'll report earnings in the week ahead. Are we going to get decent numbers here, or is there going to be some evidence that margins are under pressure and maybe that, again, is a tariff story, even with the front running that some of these companies were involved with?
Yeah, Walmart's already said that tariffs are causing some ripples in their margins. That's for sure. Now, if you look at those two as a pairs trade, I'm definitely going to pick Walmart here. Target's had some real issues on a number of different issues. They have trouble getting people into the store. They've had some bad campaigns over the last 3 or 4 years. They just got their people back into the office, I think 3 days a week, most recently. Up until recently, Target's employees, I think they only worked in the office once a quarter. That's at corporate headquarters. But yeah, I would definitely be picking lower cost retailers. like a Walmart, like a TJ Maxx or a Ross Stores over a Target, over a higher cost items.
Skyler, we'll leave it there. Thank you so very much for making time to chat with me. Skyler Weinand, he is the CIO at Regan Capital, on the line from Dallas, Texas, here on the Daybreak Asia podcast. Thanks for listening to today's episode of the Bloomberg Daybreak Asia Edition podcast. Each weekday, we look at the stories shaping markets, finance, and geopolitics in the Asia Pacific. You can find us on Apple, Spotify, the Bloomberg Podcast YouTube channel, or anywhere else you listen. Join us again tomorrow for insight on the market moves from Hong Kong to Singapore and Australia. I'm Doug Krisner, and this is Bloomberg.